Hey everyone, welcome to another video. In my last video, I spoke about a very fundamental metric of mutual fund, which is called NAV, net asset value. In today's video, I'm going to talk about the most important metric while choosing a mutual fund, which you should always keep in mind. It is called expense ratio. Expense ratio is the most significant fundamental metric for analyzing any mutual fund because it directly affects the amount of return that you as an investor can generate out of that mutual fund. So in this video, I'm going to dissect expense ratio for you. I'm going to tell you what are those expenses that a mutual fund company or an AMC accrues, which are the components which you need to look out for, and what is the exact implication of an expense ratio for the performance of a mutual fund. So without further ado, let's get into this. So friends, to run a mutual fund, there are various costs the mutual fund company needs to incur. जैसे fund manager का salary, जैसे advertising cost, the mutual fund advertisement that you see in the TV, in the YouTube, all these advertisement costs. There are operating costs, there are maintenance costs, and so on and so forth. So ये जो सारे जो costs है, all these costs which the mutual fund company incurs to run that mutual fund comes from the investment that the mutual fund company gathers from the investors. That is why it is very important for you to understand as an investor that how much cost a mutual fund company is incurring and how much they are taking from you, from your investment, to run their operations. So mutual fund expense ratio का सबसे पहला component क्या है? The first component is management fees. So management fees is the fees that is paid to the fund managers of the mutual fund. So the fund managers puts a lot of energy, does a lot of market research and so on to make sure that they are making the right portfolio allocation for the mutual fund where they will be investing your money. So they do all the researches on their own, and because of the work that they are putting in for the mutual fund, they would definitely require salary. So that salary goes from the investment amount that we put into the mutual fund. Generally 0.5 to 1% of the total investment asset value of the mutual fund is allocated as the management fees for the mutual fund. So if the mutual fund has 1,000 crores, then 10 crore will be paid as a management fees to the fund manager and the team which manages the mutual fund. Then there is maintenance expenses. So maintenance expenses are nothing but administrative expenses. For example, there are various things that needs to be kept in mind while running a mutual fund. For example, keeping records of the investors' money, keeping records of different asset allocation that is happening for the mutual fund. Then there is keeping record of the exit load, keeping record of the entry load, and so on for the mutual fund. So all these other administrative stuffs that is important to run the mutual fund is taken care through the maintenance expenses, which is also a component which contributes to the expense ratio for that mutual fund. Then there is another fee called 12B1 fee, which with the cost that the mutual fund bears for promotion of that mutual fund. Also, because the mutual fund assets keeps on changing over time, that information also needs to be spread among the masses. So all these also contribute to the expense ratio of the mutual fund. Then there is entry load, which is the amount or the cost that an investor needs to incur when investing in the mutual fund for the first time. So this is a cost which is now abolished by SEBI. It is not a part of the expense ratio anymore, but it's good to keep in mind that there can be a component called entry load as well, which can be a separate cost apart from the expense ratio. Then comes exit load. Exit load is the cost that an investor will incur when the investor is withdrawing money from the mutual fund. So this particular cost is added into the mutual fund contract to deter or to make sure that people don't withdraw very frequently from mutual fund asset pool, because all the fees that gets generated from managing the fund helps to run the fund management team. So if there is very less asset or the asset keeps on fluctuating a lot, then it will lead to lesser fees or very fluctuating fees coming for the fund managers or fund group, which also will be difficult for them to sustain. So that is why exit load is added into a mutual fund, so that it deters investors from exiting the mutual fund before a certain amount of time. So a lot of times you'll see that different mutual funds will have exit load of 1%, 2% if the mutual fund amount is withdrawn within 1 year of your investment into the mutual fund, so that investor doesn't withdraw the money from the mutual fund very soon. And the final one is brokerage fees. So brokerage fees are incurred by the investor, or investor needs to pay the brokerage fees for investing in a mutual fund if and only if the investor is buying a regular mutual fund. So every mutual fund has two different types. One is regular mutual fund, one is direct mutual fund. So if you are buying direct mutual fund, you don't have to pay any brokerage fees. This is very important, and because in course of time, if you are investing in a mutual fund for a long period of time, that small percentage of brokerage fees that will keep on paying for a long period of time will diminish your compounding return to a large extent. So you should always try and invest in direct mutual fund and not into the regular mutual fund, because in direct mutual fund you don't have to pay any brokerage fees. And there are various ways through which you can directly invest in mutual fund. We have apps and portals like Grow, Zerodha, and so on, Upstocks. With these portals helps you or provides you the avenue to invest directly into the mutual fund or invest in direct mutual funds, which doesn't have any brokerage fee. So please keep that in mind. This is very, very important. So what are the implications of expense ratio, and why should you care about it? You should care about it because expense ratio is the cost that you are incurring, which diminishes the return that you are getting out of the mutual fund. So whenever the mutual fund is reimbursed, when an investor reimburses the money of the mutual fund, the expense ratio is deducted from the entire revenue that the mutual fund generates, so that the final return that the investor gets is lesser than the total return the internal portfolio of stocks that the mutual fund is investing in has generated. For example, if the mutual fund has invested in a portfolio stock worth 100 rupees and it has moved to 150 rupees after 2 years, that is 50% growth, and the expense ratio of the mutual fund is 3%, then you will only get 47% growth, because 3% will be taken out, for the expense of the mutual funds company. So that is why it is very important that you understand the implication of the expense ratio, because this directly affects the return that you will get out of the mutual fund. Now, a lot of people think that expense ratio, if the expense ratio is higher, then it will lead to better returns, because probably they have hired highly qualified fund managers, or fund managers are taking more money because they are more trained or more skilled, and they have a bigger team, and that's why they are taking higher expense ratio, and the fund probably will perform better. This is actually not the case. The revenue or the expense ratio of the mutual fund a lot of times depends on the size of the fund. So if the fund size is small, then the expense ratio could be higher, because then the fund management team needs to drop more money, because the pool of money they have got through the investment is lower. But if the fund size is very high, then the expense ratio could be lower, because then they can afford to run the fund even with lower expense ratio, because the base of that particular asset allocation for that mutual fund is very high. So even smaller percentage of expense ratio on top of that very large base can result in a high amount of money, which is good enough for any expenses that fund management team will incur to run the mutual fund. So that is why if expense ratio is high, that doesn't really mean the fund will perform well. A classic example would be index fund. So index funds expense ratio is very, very low, because those are passive funds. They only mimic Sensex and Nifty growth, and whenever the Sensex grow, the particular fund grows. Whenever Sensex comes down, the particular fund performance also comes down, because it completely mimics the component of the Sensex. Similarly, for Nifty index funds, they will mimic the component of Nifty. And these are passively managed, because the fund manager doesn't have to really do a lot of market research to understand which stocks to buy, how much money to put in the stock, what should be the percentage asset allocation, and so on. That is the reason the expense ratio of index funds are so less. But guess what? the index funds with extremely low expense ratios has performed amazingly over past many years. Even Warren Buffett has told that no fund manager can actually outperform an index. So that is the power of index itself, because index itself has a mechanism to weed away the losers and carry on with the winners. Let me also show you how you can find the expense ratio for different mutual funds. So as you can see, I am in the homepage of Grow, which is an investment portal through which you can invest in mutual fund, stocks, and so on. So let's say if I pick any of the mutual fund, let me see all the mutual funds. There are so many mutual funds that we can see. Let me see one of the mutual funds. For example, Parak Parik Flexi Cap Fund. If I look at this mutual fund and if I go down, I'll see how the fund has grown and so on. And then if I go down, then we'll find the returns and rankings, similar mutual funds and so on, and the holdings, which are those companies the mutual fund is investing in. Then if I keep going, then you will find the expense ratio, exit load, and tax. So here we can see the expense ratio of this fund is 0.87%, and it has an exit load of 2% if redeemed within 365 days. So the expense ratio that we can see here is 0.87% of this particular fund. So now I know that what is the expense ratio of this fund, right? So let's say I want to look at another fund. Let's say I want to look at ICICI Prudential Technology Direct Fund. Let me go down. And here I can see the expense ratio is 0.96%, which is a little higher than the expense ratio of the Parak Parik Flexi Cap Fund. Now let's look at one index fund. I'll quickly search Nifty Index Fund, UTI Nifty Index Fund. So this is an index fund which mimics Nifty. So if I go down and check the expense ratio, I'll see the expense ratio is 0.2%. So it is much lower than the other funds. So the expense ratio that we have seen in Parak Parik Fund was 0.87%. The expense ratio that we have seen in ICICI Prudential Technology Fund was 0.96%, but the expense ratio that we see here in the Nifty Index Fund is only 0.2%. So as you can see, the index fund expense ratios are lower than actively managed funds, and also over the years index has outperformed a lot of actively managed funds, and that is the reason you should always look out for passive index funds when you start investing, because these are great choices. You hardly need any management, and also you need to provide a very low fee when you are investing in an index fund with low expense ratio. This brings us to the end of the video. Hope you like the video. The expense ratio as a metric is very important when you analyze any mutual fund. If you want to look at my previous video where I spoke about net asset value, or the most fundamental unit of a mutual fund, the link of that video is provided in the description box. Do check that out. It can be very useful for you. Having said that, don't forget to like the video, subscribe the channel, don't forget to share the video with others who are new to the investment journey, who want to know more. I will see you in the next video.